afternoon, everyone. As Angie said, my name is Amy, and I am a benefit counselor with PERA. Happy to be out of the office on this snowy day up in Elk River. Love getting out and doing this presentation. What I love most is when the light bulb goes off. Somebody really starts to understand how their benefits work and how wonderful of a benefit that you have. So that said, I really encourage you to ask questions if there is something that you need clarification on, because it's very likely if you have a question, somebody else is going to have that same question. So I want it to be pretty informal. I'm here to talk a little bit about PERA, what we do and how we do it, but more importantly, about how what we do impacts you and your families. I'm going to start off with a little trivia on PERA. Of these professions, who would pay into PERA? The school nurse, the volunteer firefighter, the city administrator, the ambulance personnel, or all of the above?
All of the above.
Yeah, all of the above. And as we'll see, PERA has a number of different types of plans, and these folks would participate in different plans. They're not all in the same type of plan. There are two main categories of retirement plans: defined contribution and defined benefit. I've been with PERA for over 10 years, and in my experience, our membership is far more familiar with defined contribution plans than defined benefit, and we are a defined benefit plan, so I really want to make the distinction. Let's start with defined contribution, which are performance-based plans. In the defined contribution plans, you're putting money in, you get to choose where that money is invested, and you will receive quarterly statements from the plan administrator. Depending on how well the stock market's performing, you may or may not want to open those quarterly statements, because they will show you the bottom line, whether you're earning money on your investments or losing money on your investments. When you start drawing your money from a defined contribution plan, such as your deferred compensation or an old IRA or an old 401k, it is possible to deplete it at some point. So it's very possible to outlive your defined contribution plans. On the other hand, defined benefit plans are formula-based plans. So for purposes of this presentation, I want you to think of buckets of money. I'm going to continue referring to these buckets of money. There's your bucket of money and the employer's bucket of money. So in your PERA plan, you are paying into your bucket of money off of your gross pay every pay period. And the employer is paying in to their bucket of money off of your gross pay every pay period. So these two buckets of money come into PERA. They get invested by the State Board of Investment, and it's up to the State Board of Investment to invest these buckets of money well enough in order to sustain paying your pension for the rest of your life. So there are two things I want you to remember today. This is one of them. The amount of money that comes into PERA has absolutely nothing to do with the formula that we use to come up with how much we pay you. I'll say that again. The amount of money that comes into PERA has absolutely nothing to do with the formula that we use to come up with how much we pay you. I'll go through that magic formula shortly. PERA will send you an annual statement the week of your birthday, and you will see 4 retirement dates on there. First, eligible, rule of 90 if you're eligible, 62, and full retirement age. Those are just kind of random dates that we've chosen. And you, again, will get that once a year. We take all of the factors that we use in the formula to come up with the benefit amounts that we're showing you on those statements. So again, the amount that you're paying in doesn't come into play in the formula. We have 3 defined benefit plans: the coordinated correctional and the police and fire plan. We are all school employees in this room other than myself, and therefore you're paying into the coordinated plan. By default, you're not a correctional officer or a firefighter or a police officer, so you are in our general plan called the coordinated plan. Why is it called the coordinated plan, by the way? Does anybody know what it might be coordinated with? What other benefit will you expect to receive in retirement? Social Security. So you're in the coordinated plan, you're paying in to both PERA and the Social Security Administration, and thus you're going to be entitled to benefits from both systems. We also have a volunteer firefighter plan that is a lump sum payment plan based on the number of years a volunteer firefighter has been doing such work. And we have a small defined contribution plan for physicians of county facilities, elected officials, and ambulance personnel. So PERA runs the gamut between defined contribution, defined benefit, and lump sum payment plans. To give you some perspective, we're the largest public pension plan in the state. We're larger than MSRS, who administers the state retirement system, and we're larger than TRA, the Teachers Retirement Association. Our plans are funded by those buckets of money. You're paying 6.5% off of your gross pay, and your employer is paying 7.5% off of your gross pay into PERA. Those contribution rates are subject to legislative change. They also come off your gross pay, thus reducing your taxable income today. You will pay taxes on your benefit when you start collecting a monthly payment. Now, these contribution rates do change from time to time. I've been with PERA for 10 years, and I think we've seen 2 contribution rate changes since I've been with PERA. When contribution rates increase, it doesn't mean that your benefit is increasing because of that first point I wanted you to remember, which was what? Yes, contributions don't affect benefits, absolutely. So what it means when contribution rates get legislatively increased simply needs more money to be invested to sustain paying everybody's pension. And it reduces your net pay a little bit. The State Board of Investment invests about $29 billion in PERA assets. They invest diversely. They're not looking for quick growth. They're looking for long-term growth. We expect an 8% annual rate of return from those investments. They had an excellent year in fiscal year 17 with a 15.1% rate of return, which was significantly higher than the negative 0.1% rate of return in fiscal year 16. So they have corrections and then they have really good years. So that's why we're looking at the long term. Over the last 20 years, they've averaged over a 7% rate of return. So we're pleased with the performance from the State Board of Investment. They're doing right by our buckets of money, and our pension will be there. Our funding level in the coordinated plan, this should say as of June of 2017, for the coordinated plan was 77.8%. So that doesn't seem very good, and yet it's not all that bad. It's actually significantly improved from a few years ago. There were sweeping legislative changes made in 2010 to help shore up our funding. And this is important to those of you who will be retiring in the next year or 2 years, because we pay annual increases to retirees. Those annual increases in the coordinated plan are 1% a year. The way the legislation is written right now is that we'll pay 1% annually on our retiree benefits until our funding level is 90% 2 years in a row, at which point we would then be able to pay 2.5% increases. We are decades away from being 90% funded, let alone 2 years in a row. So expect that you will receive a 1% increase annually when you start collecting your benefit. Our revenue, by and large, comes from the investment growth, over 64% from investment growth alone, about 19% from employer contributions, and 15% from our own contributions. So it's not the general public on the hook for our cushy public pensions. It's the investment growth and our own contributions that make up the majority of PERA's revenue, a small percentage from public dollars. And our expenses, by and large, we are a benefit-paying organization, so the expenses that we pay out go toward paying retirement benefits, disability benefits, and survivor benefits. Only 3% of our expenses go toward paying refunds, so a member who wants to cash out their bucket of money will pay interest on top of what they paid in. And about 1% of our expenses go toward the administrative costs of paying our salaries and the money management fees that we pay to the State Board of Investment, which is about 70 cents per $1,000 invested. Pretty low money management fees. All public retirees combined between the 3 major funds, MSRS, TRA, and PERA, those retirees pump 3 times as much money back into Minnesota's economy as public employers pay into the system. So, in other words, public retirees are a huge boon to Minnesota's economy. Here's the other thing I want you to remember. So what was the first thing again? The amount of money you pay into PERA has nothing to do with the formula that we use to come up with how much we pay you, all right? I like to repeat myself because it's easier to remember with repetition, right? And I'm only here for a day, so it's okay to be redundant. Not even a day, an hour. All right, so you have been paying into your pension for decades, most likely. People stay in public service for a very long time. So if you were to look at the balance of your bucket of money, it would be tens of thousands of dollars. Looks like a lot of money. And yet when you start collecting your monthly pension, you will recover that bucket of money in the first 2 to 3 years. So in a very short period of time, you get back every dime that you've paid into the system. Over the next 5 to 7 years, you'll collect that other bucket of money, the employer's bucket of money. So in less than 10 years of retirement, you get back every dime that's been paid into the system on your behalf, and now for the rest of your life, that monthly pension that we pay you is based on the growth of the investments. And this is why it's so important for you to understand the role of the State Board of Investment, and that they are investing well and investing right. They're doing right by us, and there will be enough money to pay your pension for the rest of your life. It's my favorite slide. Sums up the value of your pension very nicely, I think. On average, a gentleman today, 65 years old, can expect 18 years of retired life. And ladies, we're either killing them off or we're doing something right because we get a couple years on them. Maybe it's we have less stress once they're dead. I don't know what it is, but we are living longer than the gentleman. So we get a couple more years. And this is an actuarial table based on PERA retirees. So these are averages. Of course, we'll have some people live much longer and we'll lose some sooner than these ages. To be vested, to qualify for a pension, if you came into public service prior to July 1st, 2010, you were vested with 3 years of service. And if you started your public service July 1st, 2010 or thereafter, our vesting schedule changed to 5 years. So vesting simply means to qualify. I should have put the age on here as well. Do you know what your first eligible age is to collect a pension in the coordinated plan? 55, absolutely. Very good. I wish I had prizes.
I do too.
I need to get a big bag of candy from Costco. Absolutely, 55 is your first eligible age, but if you were to collect at 55, unless you had Rule of 90 and started public service as a baby, it's very difficult to reach Rule of 90 at age 55 or before age 55. But 55 would be your first eligible age, although that would be a significantly reduced pension, as we'll see in the formula here. So now we're going to go to that magic formula. There are 3 factors that come into play with this formula. Does anybody want to shout out the 3 factors? I kind of just gave one away.
Years of service.
Age, years of service, high 5 salary. So let's start with age. There is some significance to the date, July 1st, 1989. What happened July 1st, 1989 in regard to your pension? Come on. Some of you know this. Some of you were discussing this when I came in, or when you came in. The Rule of 90 died. The Rule of 90 went away July 1st, 1989. So that means if you started your public service June 30th, 1989 or earlier, you could potentially reach the Rule of 90. And the Rule of 90 is a big deal. I mean, you know when people are in the year in which they're going to turn or reach their Rule of 90, because they put banners outside their cubicles, they put big X's on their calendars with countdown dates. It's a big deal. And people have a new swagger, a new attitude once they hit their Rule of 90, because they know they can walk at any time, so you don't want to mess with them. They've got all this knowledge that's going to walk out the door with an unreduced pension, so you better be good to them. July 1st, 1989. So if you came into public service prior to that date, when your years of service added to your age, if that equals 90 or more, you can retire without a reduction factored into the formula. So a 60-year-old who has 30 years of service credit, they can retire without a penalty. Now, if that 60-year-old wants to continue working in their public employment, their benefit is going to increase because of the second factor here. The second factor that goes into the formula would be years of service. Every month you work at least one day in a month, you earn service credit for that month. So you can earn 12 credits in a year. Obviously, the more service credit you have, the higher your benefit's going to be. So that 60-year-old, even though they've met rule of 90, they can continue working, earning more service credit, and getting a higher benefit. So the rule of 90 doesn't mean they're going to get the same benefit that they would get had they continued working until their full retirement age. It simply means that they can retire without a penalty for early retirement. That same 60-year-old who started after July 1st, 1989, they have 30 years of service credit. They can retire, but they don't have the rule of 90 because they came into public service after that trigger date. So there is going to be a penalty or reduction factor factored into the formula for early retirement. They would have to stay in public service until age 66 to get an unreduced pension if they started after July 1st, 1989. So I want to make, this is a confusing thing, so I want to make it clear what your full retirement age is from a PERA standpoint, not Social Security standpoint because it's different, but from a PERA standpoint, that July 1st, 1989 date is a trigger point. So if you came into public service prior to that date, your full retirement age from a PERA standpoint is 65. If you came in after that date, your full pension age from a PERA standpoint is 66. From a Social Security standpoint, it's going to be somewhere between 66 and 67. So there's that confusion, a little clarification there, hopefully. So back to the formula, the next factor would be your high five salary. A high five salary is the average of your highest 60 consecutive months of salary. And I'll say that again. It is the average of your highest 60 consecutive months of salary. So for most of us, that will be our last 5 working years. Most of us are making more in our last working years than we were earlier in our career. So every month we make more money now, a month 60 months ago drops off that range. So it's moving forward month by month if we're making more now than we were 5 years ago. But it's not necessarily the last 5 working years because we have folks who cut their hours to half-time in their last couple years of work. In that case, the high five will be frozen over the period of time when someone was still working full-time. So wherever this 60-month range falls, that is what we will use in the calculation. It's not necessarily going to be the last working years. So these factors get multiplied together along with a plan-specific percentage to come up with what's called the single life benefit option. The single life benefit option is the highest benefit option that you have. You're going to have 5 choices at the time you complete a retirement application. The single life benefit option will pay you every month for the rest of your life, and the benefit will end upon your death. In other words, nobody other than the member is getting a monthly payment with the single life option. In lieu of the single life option, there are 4 survivor options. A survivor option allows you to take a reduced benefit and name one person to receive a percentage of your benefit upon your death, and that will be payable to that person every month for the rest of their life. This is a choice you make at the time you complete a retirement application. This is not something you've already decided. You do not make a choice on a survivor until you complete the application. So again, survivor option is only one person. It is irrevocable. and it's payable for life upon the member's death. A choice you make at the time of retirement, as opposed to beneficiaries. So oftentimes people get survivor option and beneficiaries confused, and they're not the same thing. So we understand, backtracking here, we understand survivor option is a choice you make at the time of retirement. If you look at an estimate that we have worked up for you, if you're married, by default, you will see those survivor options on that estimate worked up for your spouse. That's simply a courtesy. Does not mean you've chosen them. I'm happy to give out my date of birth if you want to list me as your survivor. Or at least kick tires and see what it's going to be for me. Okay? Doesn't have to be your spouse, it doesn't have to be a family member, it can be anybody, but it is only one person. When I'm talking about beneficiaries, I'm using the plural. So you can name multiple beneficiaries. You can have primary beneficiaries and secondary beneficiaries. You can have entities and you can have trusts listed as beneficiaries as well as individuals, whereas that survivor option is only an individual. You can change your beneficiaries at any time, and these are folks or entities or trusts that you have on file now. So if you've come into public service or you came into public service decades ago and you haven't looked to see who you have listed as beneficiaries since you came into public service, it's probably a good idea to look, because you don't want your ex-spouse as your beneficiary or your mom and dad, and maybe you've lost mom and dad by now. So update your beneficiaries, because these are the folks who are going to get your bucket of money if you pass away before retirement. A benefit estimate from PERA looks like this. If we were to work one up in the office, it's going to look like this. Your name will be listed at the top along with your date of birth. If you're married, your spouse's name below yours along with their date of birth. The third row down will show you your contributions, your bucket of money, plus interest. We would pay interest on top of what you paid in if you want to cash this out in lieu of taking a monthly lifetime pension. If you want to forfeit a monthly lifetime pension, you can cash out your bucket of money with interest, or you can take a monthly benefit for the rest of your life. I have a blow up of this. It's just a little easier to read. Here I have a 63-year-old member whose single life benefit is $1,079. They have a potential survivor who's 2 years younger than they are. And I point out that age difference because if the member is going to provide a survivor benefit for this person, they're taking a reduced pension. The way that pension reduction is calculated is based on the life expectancy of the two parties involved. That's why it has to be a person for a survivor option, because we need to be able to tie it to a date of birth. So with a 2-year age difference, the life expectancy of these two parties is going to be roughly the same. One isn't expected to live a lot longer than the other. So with this person as the member's survivor, they're just going to see a little bit of a reduction with each survivor option. Now the survivor options are listed to the left, the 25%, 50%, 75, and 100%. Those are the 4 survivor options. To provide 25% of the member's benefit, they will take roughly a $30 reduction from their single life benefit in this example. Again, because there's only a 2-year age difference, the member is not taking much of a reduction to provide survivor options. Member passes away first, they've chosen this 25% option. We pay 25% of what we were paying the member every month to the survivor for the rest of their life. To provide 50% of the member's benefit, they're going to take roughly another $30 reduction from their single life benefit amount. And then the member passes away first, we'll pay half of the benefit to the survivor every month for the survivor's lifetime. A little more of a reduction for a 75% option and a little more of a reduction for the 100% option. Members often confuse the single life benefit option and the 100% survivor option. They'll say, I want to take my full benefit, I want the 100% option. Okay, those are 2 different things. The full benefit is single life. 100% option is the lowest benefit to a member, highest benefit amount to a survivor. So keep that in mind. Single life and 100%, two different things, two very different things. Whatever you choose at the time of retirement is irrevocable. Once we have paid you, you cannot change this. With some exceptions, which I'll get to. Yes?
I'm sorry if I misunderstand, but I thought you said the single life benefit, that it pays one person until you die.
The single life benefit pays the member until they die. There's nobody other than the member who's going to get a monthly payment with a single life benefit option.
So why is survivor listed? That's what I'm not understanding.
This is just a blow up of the estimate page, and so all of the options are listed here. The single life option is listed and the 4 survivor options are listed. So it's just showing all of the 5 options. Good question. Now you can name any one person for a survivor, and if they're your spouse, there are no restrictions. You could have a 30-year age difference between you and your spouse, and there are no restrictions. You could name them for any one of the 4 survivor options. Restrictions do come into play with the 75 and 100% options if they are not your spouse. So if they're more than 10 years younger than you, the 100% option is off the table if they're not your spouse. And if they're more than 19 years younger than you, not your spouse, the 75 and 100% options are off the table. The IRS gets involved, they do funky math, and so 19 doesn't really mean 19 and 10 doesn't really mean 10. So if you are thinking of naming a survivor who's kind of close to that 19-year age difference mark and that 10-year age difference mark, be sure to have us run the calculation for you or go on to your PERA account and run the calculation for that person. Because of this IRS funky math, you may have the 75 or 100% options anyway, even given those restrictions.
Well, more than likely with your child,
Mhm.
that you would be in the 25 or 50.
Exactly. So if you were thinking of naming one of your children, or especially a grandchild, you would be limited for sure to the 25 or 50% option unless you had your child when you were under 19. If you have taken a reduced pension and you've named a survivor and your survivor predeceases you, we will do what's called a bounce back to the single life amount. So you're not going to be taking a reduced pension for the rest of your life. We will bring you back to the single life amount. You do not, however, get to name another survivor. Now, I said that it's irrevocable with some exceptions. I really like you to think of your option as irrevocable once we have paid you. Think of it as set in stone. That is the way it used to be prior to 2010. There were some legislative changes in 2010 that said, yeah, there's enough people who are getting divorced after they've retired. They're spending too much time together, and somebody doesn't want to be married anymore. So the law changed and does allow for a revocation of an option if a member goes to court and can get their soon-to-be former spouse to sign off on court documents stating they are okay with giving up a lifetime monthly pension. We will remove that person from the survivor option and bring the member back to the single life option for the rest of their life. It just does not happen very often. That is a really difficult thing to get done. So keep in mind, think of it as being irrevocable. If you've named somebody who's not a spouse as a survivor and you want them removed, it's a little bit easier. It's a matter of having them sign some PERA documents. Still a difficult conversation to have. So, if you are successful in getting somebody removed from your benefit, we will treat it kind of like a death, where we bring you back to the single life amount for the rest of your life. You do not get to name another survivor. So you can't remove your spouse and then have your significant other put on. Okay. Deferred pensions, most folks are going to collect their pension right away, and your first eligible date to collect your pension is the month following termination. Here we have a 47-year-old who leaves public service. They're in the coordinated plan. They're not eligible to collect until 55. They could collect a significantly reduced pension at age 55, or they can defer it to get a higher pension. They're not continuing to work in public service. They don't have any more salary. They don't have their high five isn't increasing, and they're not getting more service credit. But simply by getting older and having less of a reduction factored into the formula, the benefit is increasing the later they delay it. So they can delay it till their full retirement age of 66 and get an unreduced pension, or they can delay it beyond 66. It's not affecting their pension. It's already unreduced at age 66. But by age 70 and a half, the IRS says they have to take it because the IRS wants their tax dollars. Refunds or rollovers. Remember, one of your options is to cash out your bucket of money, in which case we'll pay interest. If you want to cash this out in a lump sum and have us issue you a check, we will withhold 20% in federal tax. You will still owe state tax and perhaps a 10% federal penalty if you've taken this out before age 59 and a half. So that's some significant taxes and penalty there. If you want to put it into another tax qualified account, there are two ways of doing it. You could do the rollover yourself, or we could do the rollover for you. The difference here is that if you do it yourself, we are sending you a check and we're withholding 20% in federal tax. Whereas if we do it for you, it's a non-taxable event. If you do that rollover yourself, you have 60 days in which to conduct the rollover and make it whole. So you're sending the check and the 20% that we have withheld into that other account. You have 60 days to do that, in which to not have the tax liability of that disbursement for that year. But again, by taking this lump sum or rollover, you are forfeiting a monthly lifetime pension. Combined service annuities. Anytime someone has more than one public pension plan, we want to have the conversation about a combined service annuity. Remember, PERA has 3 defined benefit plans. You're all in the coordinated plan. We also have the police and fire plan and the correctional plan. So oftentimes folks will have service in more than one PERA plan. Or we often have folks who have worked for a state agency at one point in their career, at which point they would have paid into MSRS, that pension system. Certified teachers pay into TRA. Oftentimes, people will start their career in a PERA position, a school position, non-teaching, while they're going to school to become a teacher. They get their teacher certification, they get a teaching position, they leave PERA, they start paying into TRA. So they have more than one pension plan. So let's go through an example of how a combined service annuity works. When somebody has service with 2 different pension systems, for example, here we have PERA and MSRS, even though it's called a combined annuity, they're still separate benefits. So in this example, someone started their career working for the state of Minnesota, paying into MSRS, and then they left the state and they came into the school district. And they've been with the school district for 20 years, paying into PERA. Their high five is with their PERA position. This person has earned a 3-year benefit from MSRS and a 20-year benefit from PERA. Here's where the combined part comes in. Both systems will calculate their benefits using the same high five salary. So all 23 years in this example will be calculated using PERA's high five salary. Their 3-year benefit and our 20-year benefit. So this person is not penalized for having left the state and come into the school district, because all of their years of service are calculated with the same high five salary. Just says you can take a refund when you leave public service, you can cash out your bucket of money. By virtue of coming back to public service and being an active member, you can reinstate forfeited time. You must be back active for 6 months, and you need to buy this time back within 6 months of terminating again. So essentially what you're doing is you're putting the money back into the system as if it was never gone. When we pay a refund, when you cash out the money, we pay 4% interest, compounded annually from the date that you originally started contributing to the date it's paid out. How much do you think you're paying in interest when you're reinstating that time? Remember, it's just as if the money was never missing from the system. Nope, we pay 4% when you cash it out, but do you remember what I said about the rate of return we expect from the State Board of Investment? It's 8%. We expect an 8% annual rate of return. So when somebody is putting their money back into the system, it's calculated at an 8% rate of return, 8% rate of interest. So it's just as if the money was never missing. The easiest way to buy back forfeited time is to roll money over from a tax-qualified account, such as your deferred compensation plan, or an IRA, 401k, 403b, and so forth. Here's an example. Someone has 5 years of forfeited time, and PERA is saying it's going to cost $45,000 to reinstate that time. We show a side-by-side estimate comparison, what their benefit will be without repayment and with repayment. In this example, there's a $500 monthly benefit difference should they reinstate the 5 years. We want to determine whether it's financially worth it to this person to do this, so we do a little math. Don't run. I've done it for you. We take the $45,000 purchase cost, divide by the monthly benefit difference of $500, divided by 12 months to get a break-even point of 7.5 years. So if this person reinstates the 5 years, they get that extra $500 a month, they will recover their $45,000 in 7.5 years. That's the break-even point. At that point, they are $500 a month ahead of the game for the rest of their life. So there are two things we don't know to determine whether it's worth it to this individual to buy this time back or not. We don't know if they have $45,000. That would be key. Let's assume they do. We don't know how old they are. Let's say they're 78 years old. Does it make sense for this person to buy back? No, probably not. They're going to recover their $45,000 at about the time they're expected to pass away, mid-80s. If they're 60 years old and they're going to break even at age 67 and a half, does it make sense for the 60-year-old to buy this time back? I would say probably. Yeah, because their life expectancy is still around another 20 years once they break even. $500 ahead of the game per month for 20 years is probably worth it. So, if you have forfeited time, when you receive an estimate, the last page of your estimate will be this transmittal for purchase. This will show you how much it would cost you to buy back the forfeited time. It will show you all of the different types of funds that you can roll money over from. It doesn't show you your break-even point. That would be on the actual estimate itself. But if you aren't quite sure whether it makes sense to buy back any forfeited time, I would do one of two things. Either talk to a PERA benefit counselor or talk to a financial planner who can help you determine that break-even point based on your financial situation, your age, your health, all kinds of factors, help you determine whether it makes sense for you to reinstate forfeited time. Typically, we find that somebody's going to break even in under 10 years. So for most people, it does make sense to buy back forfeited time, but not in all cases. Up to this point, I've been talking about retirement benefits. PERA also has some disability benefits for folks who find they are unable to do any type of work. Qualifying for a disability in the coordinated plan, you need to be deemed unable to do any work, not just the job that you had, any work for at least 1 year. You must supply medical evidence of your claim. You need to be active in public service when the disability occurred and apply within 18 months of a termination. You need to be under your full retirement age, and you cannot be collecting a retirement benefit. The disability classification for a coordinated plan disability claim is total and permanent. You need to be deemed unable to do any work for at least a year, and your medical personnel has to say that, has to sign off on paperwork saying you're unable to do any type of work for a minimum of a year. The formula to come up with a disability benefit is the same formula that we use to calculate retirement benefits. with the exception of no reduction for age. So a 60-year-old who has a successful claim for a disability will have their age not a factor. They'll have their service credit, their high-five salary, and the coordinated plan percentage multiplied together, and that would be their disability benefit. So age doesn't come into play with a disability benefit. There is a renewal on the disability annually. So if you do get approved for a disability benefit, every year you need to have medical personnel sign a form indicating whether or not you are still disabled. Applying for a disability is a process. It takes months. So you have to kind of, if you're not working and if you're applying for a disability in the coordinated plan, you're probably not working because you can't work, right? That's the whole crux of everything, is that you can't work for at least a year. It can take months. So what you'll do is you'll submit an application along with all the supporting documentation, 2 medical reports completed by your medical personnel, one of whom is, at least one of whom is an MD. That all gets submitted to this outside organization, third party, called AMRO, Medical Management Review Organization, and they take it through the claims process. So somebody from AMRO would give the member a call. They would be the liaison throughout the claims process. AMRO makes the determination on whether you're qualified for a disability benefit or not. They are medical personnel, we are not. If you are approved, then it comes back into our office and we can pay you when all of your time is off the books, all vacation time, all sick time off the books. That all has to be used up. If AMRO denies the disability claim, then you can appeal to our board of directors to see if they will overturn that decision. Survivor benefits would be paid if you die before retirement. Your bucket of money, this is where this comes into play, particularly if you're a single person. If you're married, it's a little different. So let's start with married folks, because most people are probably married. You are, well, I shouldn't even use this as an example because it's a bad weather day, but you're on your way home today. Hopefully, God willing, you get home safely. But something happens, some tragic accident happens, and you get killed. If you're married, your surviving spouse is going to have some options if you were vested, and if you're over 55, they'll be eligible right away. If you're not 55, they would wait until you would have turned 55. So you're married, you die, you're active, contributing. Your surviving spouse has several options. One option is the 100% survivor option based on the amount of service credit you have at the time you died. So remember those 4 survivor options, 25, 50, 75, and 100%? They only have the 100% as far as a survivor option. So it's a lifetime benefit for the rest of their life based on the amount of service credit you had at the time you died. Or they could take what's called a term certain benefit. So it's that, it's the actuarial equivalent to the lifetime benefit paid out for their lifetime, but squished into a shorter period of time. So a higher monthly benefit for a shorter period of time, 10, 15, or 20 years. So higher monthly benefit for that shorter period of time. Only for that shorter period of time, the benefit would end at the end of the 10 years with the 10-year term certain, or 15 or 20. Or instead of the 100% survivor or one of the term certains, they could cash out your bucket of money with interest. So those are the 5 options that your surviving spouse is going to have if you're married. If you are single and you die before retirement, now your beneficiaries are going to get your bucket of money in a lump sum. Primary first, if primary's gone, then it would go to the secondaries. So if you're single and you pass away, there is no monthly lifetime payment to anybody. It's only a lump payment of the bucket of money. Any questions on that? No? Okay. No surviving, or excuse me, no dependent children benefits in the coordinated plan.
Is that money, survivor benefits, are those taxable or?
Yes, all benefits payable from PERA are taxable, whether it's a lump sum payment, a survivor benefit, or a member benefit. Yeah, good question. which comes up in my miscellaneous section, but that's okay. Benefits are taxable. All contributions since January of 1983 have been contributed to PERA pre-tax. So you will pay your taxes on the benefit when you start collecting. You get choices on what to have withheld from your benefit. If you did have contributions prior to January 1983, you would fall under what's called the simplified general tax rule, where you would get a portion of your benefit untaxed over your life expectancy. So it's usually just a few dollars a month untaxed over 30 years. So bottom line is you're not going to be taxed twice. I'm not going to talk about pension maximization unless I have more time, because I'm running out of time, and this is more important. The 30-year break legislation, Minnesota state statute says that you need to have a 30-day break in order to collect this benefit, to be eligible for this benefit. So you need to actually terminate all public service in the state of Minnesota, local government, state government, and public school teaching positions. You can have no written or verbal agreement with any public employer that you're going to start collecting your benefit and then come back to work for them, or come to work for them if it's a new employer to you. So don't talk to any public employers when you apply for this benefit. Have a 30-day break. Don't have anything lined up. Don't answer the phone if you know it's your former employer calling you to find out where you filed something, because somebody's going to overhear that conversation and then call us. And if you are found to be doing some form of work for a public employer, we're going to stop your benefit. You're going to owe us your payments back, and we're going to start holding deductions if you are still working for them. So we take that very seriously. If you think you're going to be an independent contractor, run that by us first. We will make the determination on whether you're an employee or an independent contractor. This 30-day break, again, I will reiterate, is all public service in Minnesota, state employment, local government, and teaching. And I point that out because now I'm going to switch my terminology on this next thing I talk about. Or not. It's not what I was expecting to come up next. Paperwork, so hold that thought. Paperwork, there are three things essentially that we need in order to pay you. Identification would be the first thing. On the one hand, we can take passports, and that would be all we would need is a photocopy of your passport, you and your survivor if naming one. Not everybody has a passport, but everybody has a birth certificate. So if you don't have a passport, then we'll accept a birth certificate, photocopy, and name change documentation. So if you have changed your name since what it states on your birth certificate, we need a paper trail of name changes. If you've changed your name 5 times, we need the paper trail of name changes, all 5 different changes. But if you have a passport that's in your current name, it doesn't matter how many times you may have changed your name already in life. As long as that passport's in your current name, that suffices. We need a retirement application. The first of the 2 PERA documents we need. It's a pretty straightforward application. On the front page, you'll list your name, spouse's name, whether or not you'll answer the question whether or not you've contributed to any other public pension plans in the state of Minnesota, and you'll attach a voided check so we can set up your direct deposit. On the second page, you'll indicate whether you're taking a single life or a survivor benefit. That's the irrevocable piece. You'll sign this in the presence of a notary public. Your spouse will sign it, also having their signature notarized. This is marital property. So if you get divorced, it's very likely your pension's going to be impacted. And your third page will be your tax withholding options. You have 2 options for federal, 2 options for state of Minnesota. First option for both would be to not have any taxes withheld. And the second option is like filling out a W-4 when you start a new job. You would indicate how you want it withheld, whether you file single or married, and the total number of exemptions you claim. And then if you want an additional dollar amount beyond that withheld, you could do that. We only withhold state tax for Minnesota, so if you live in Wisconsin or you're moving out of Minnesota in retirement, we won't be able to hold state tax for any other state. If you move to a state like Florida that doesn't have state income tax, you won't owe state income tax on this benefit if you live there more than half the year. By the way, you can change your tax withholding on your PERA account at any time. That's not irrevocable. The second of the two PERA documents is the verification of termination form, which you would bring to your Human Resources office once you've notified them that you are retiring. They will sign off on this, indicating that you do indeed have a termination date on file. You have no written or verbal agreement with them that you're going to return to work. Ideally, we would get this paperwork in our office 2 months before your termination date. This is all outlined in the retirement checklist, which you can find online. The left-hand side lists all of that paperwork. The burgundy box addresses the 30-day break legislation, and this brochure also gives you a heads up on when your first payment will come. There's a distinction between your termination date and your benefit effective date. Termination date will be the last day that you work or have hours paid. So if your last day worked is June 30th, your benefit begin date can be July 1st, or benefit effective date is July 1st, the first of the month following termination. First payments will come about 2 weeks in from your effective date. So in this example, mid-July, around the 15th of July is when you would get your first payment. That would be a full payment for the month of July, and then subsequent payments would be paid on the first business day of every month. So just expect that that first payment would come mid-month. So people often say, well, what time of the month should I retire, the beginning or end of a month? Really, from a PERA standpoint, it doesn't matter, because if you work one day in the month, you're earning service credit for that month. But from a practical standpoint, we do encourage folks to consider terminating at the end of the month when possible. Not always possible with school employees, I understand that. But if possible, we do encourage you to look at terminating at the end of the month for 2 reasons. Number one, if you're still building your high-5 salary, remember, if you can get as much of that higher salary in that last month as possible, that last month will be included in your high-5 range, and thus you're going to maximize your benefit. That first payment coming mid-month, remember, if you terminate at the beginning of June, you could be waiting 6 weeks to get your first payment from us. Whereas if you terminate it at the end of June, you're waiting 2 weeks to get your payment from us, and probably getting your last paycheck around the same time as you get your first PERA payment. So. This retirement checklist is on our website. Our main website is mnpera.org, and then you can go under forms and brochures and find this retirement checklist. Now I'm going to change my terminology. So remember, I said that you need that 30-day break from all public employment. Now I'm going to talk about going back to work specifically for a PERA employer. So any local government entity would pay into PERA. So this would be cities, counties, school districts, police departments, fire departments, correctional facilities, or townships. Any local government entity in Minnesota pays into PERA. The Social Security Administration sets earnings thresholds for people who are receiving Social Security benefits. The earnings thresholds mean they can earn up to a certain amount without it impacting their Social Security payment. If they exceed the threshold, a portion of their Social Security payment gets cut. PERA retirees who go back to work for a PERA employer have these same earnings thresholds in place. So a PERA retiree who takes a job with a PERA employer in 2018, if they're under their full Social Security retirement age, the earnings threshold in 2018 is $17,040. They can earn up to that working for a PERA employer without it impacting their pension. For every $2 they go over that threshold, $1 of their pension goes into an escrow account. They get it back basically 2 Januaries later. They never lose a portion of their pension if they've exceeded the threshold. It's just if they exceed the threshold, a portion gets set aside. For somebody turning their full Social Security retirement age in 2018, the earnings threshold is significantly higher, $45,360. Same offset. If they exceed the earnings threshold working for a PERA employer For every $2 they exceed the threshold, $1 of their pension goes into an escrow account. They get back 2 Januaries later. And when somebody hits their full Social Security retirement age, they can make as much money as they want, and it's not going to impact their pension. Keep in mind, these thresholds only come into play if it's a PERA employer that you go back to. If it's the private sector, you can make as much money as you want and it will not impact your pension. If you go to work for the state, you'll pay into the state pension system and earn a pension from them, but it will not impact your PERA pension. I was going to say something else about that. It will affect Social Security, yeah. Oh, what I was going to say is that if you do, as a retiree, take a position with a PERA employer, be sure that employer knows that you're a retiree and they won't take PERA deductions out of your pay, and you will not be building service credit. You're done with that. They will, however, be reporting your salary to us, so if you are getting close to these limits, we will notify you that at some point then we're going to have to hold some of your pension aside. So PERA retirees don't continue paying back in to PERA once they retired. Online access. Has everybody been in their MyPERA account? Most of you? Okay, excellent. If you haven't, you do have access to your personal information from your home computer. It's called MyPERA. You'll just want to visit our main website, which is mnpera.org, and then the MyPERA link is in the left-hand column. You'll be able to register as a new user if you haven't already set up an account, and then active members can create their own benefit estimates there, review the salary that you've received over the last 12 months. It will qualify as income verification if you want to print that off and bring it to the bank for a bank loan. Retirees can maintain that same MyPERA account and change direct deposit account information and tax withholding. They can change right online. And they can get the 1099-R tax form to file with their tax return every January. We will mail one, the 1099-R, every January. It's available online sooner than most folks are going to get it in the mail. So to log in, you just need your email address and your password. If you haven't created the account, again, you'll want to click on the MyPERA link and then register as a new user. You'll need your Social Security number, your date of birth, and your zip code. And the system will also prompt you to set up some security questions and answers that only you will have access to. We don't have access to that information. And then you can go into the retirement calculator and you can do some different scenarios based on ages or dates. If you're thinking of retiring at 62, but you also want to see what it would be if you retired at 66, you can plug in those 2 different dates and run a calculation, and it will be done in 5 minutes. So this is the same software that we're using in Office to run your calculations. No difference, same software. You can get it in 5 minutes by doing it online yourself, or you can wait 6 weeks for us to do it in Office and mail it to you. I'm just saying, it's the same thing. All of our paperwork, the application, the verification and termination form, there's a worksheet called a ballpark estimator to help you determine if you're financially ready to retire, and then a working after retirement and retirement checklist brochure. That can all be found on our main website. You don't have to log into your MyPERA account to access these documents. Just go to our main website, and the right-hand column, you'll see a link for the retirement toolkit, and all of those documents are right there. The application and the verification of termination form are interactive, so you can type in your answers and then print it out. Currently, we don't have the capability of accepting applications online because you do need to print it out and still sign it in the presence of a notary public. Educational programs, the best thing you can do to understand your pension is to attend educational programs. So this is an overview. We come out to employer sites and do these every day of the week. If you are within 5 years of retirement, I strongly encourage you to come to one of our pre-retirement workshops in the St. Paul office. It's a full-day event from 9 to 4. We'll cover Social Security, Medicare, the psychological preparation for retirement, this presentation again, and we have a financial planner who will talk about estate planning and tax planning and long-term care planning and consolidating accounts in retirement. We have Kusky Financial come in. They are there to educate. They are not there to sell their services, but they're certainly willing to meet with members if they want to set up a one-on-one consultation with Kusky. It's a free 1-hour consultation at a later date. But Kusky's been working with PERA for 30 years on an educational basis with these workshops, so they understand how your pension works probably better than any other public or financial firm in the Twin Cities. So you can sign up for that pre-retirement workshop online. And then within 1 to 3 years of retirement, sign up for a group conference where we'll go through the whole process of applying for your benefits step by step in great detail, going through the paperwork. Finally, the last word is from our attorneys, who want you to know that everything we do at PERA is per statute. So anything that I have said that conflicts with the statute wins. Any questions? No questions?
I have a question.
Yeah.
I went into my PERA and I've worked for the school district for 29 years, but it has 25 years.
Okay, so it's possible that a couple of different things. Perhaps when you started, you were part-time and didn't meet the eligibility threshold for earnings, so you may not have been paying into PERA the first few years. Or perhaps you went on a medical leave and didn't earn any service credit, or maternity leave and didn't earn service credit if you had children. I mean, those are just the things that come to mind. If you were to call our call center, they could look into your account and tell you specifically what months are missing. Yeah.
Does PERA have an accelerated program?
We do not. I know Teachers Retirement has an accelerated program. PERA does not. Any other questions? No more? Going once? Going twice? I know that when I stop this, or I say you can go, I have 5 people lined up to ask their questions. So don't be shy. Yes, in the back.
Usually, when we can roll over, under deferred pension, we can roll over to a 457B, 403B, IRA, or those sort of things.
To cash it out and forfeit a lifetime monthly pension? Is that what you're asking about? Yes, yeah. So if you want to forfeit a lifetime monthly pension, when you leave public service, you can certainly cash out your bucket of money plus interest and roll it into an IRA or a 401k if you're going into the private sector. I would talk to either a financial planner or a benefit counselor before doing such a thing. We will talk you out of it. No. We'll find out why you're interested in doing that. Any other questions? All right. Oh, yeah.
What was the date again before it went from 3 years to 5 years
To be vested,
Yeah.
that would be July 1st, 2010. All right, thanks everyone. Good luck with your retirement. Sign up for a workshop. We'd love to see you.